Welcome to the deep dive. Today, we've got quite a stack of sources laid out in front of us. They really paint a picture of the late 2025 landscape.
That's right. Everything from, macroeconomics and tech investment down to some surprising consumer pain points.
Exactly. And our mission today is to try and connect these threads. We want to move from, say, the high-stakes political gridlock that's shaping personal finance, all the way down to, believe it or not, the cost of a Halloween candy bar.
Yeah, it's quite the range. And what really stands out is this confluence of factors. You've got economic uncertainty, inflation, the whole interest rate debate bumping right up against these incredibly rapid tech shifts, especially the AI investment boom.
It forces choices, doesn't it, on businesses, on consumers, big choices.
Absolutely. High-stakes decisions are being made everywhere you look.
Okay, so let's start where maybe the financial pressure feels most immediate right now. Washington, D.C.
The government shutdown.
Yeah, it's now hit the 30-day mark. And this isn't just political theater, right? Our sources are putting numbers on it, costing the economy somewhere between $7 and $14 billion.
And that's before you even get to the human cost.
Yeah.
750,000 federal workers furloughed. That's a lot of households impacted directly.
So if we dig into the why this deadlock, it seems to circle back to something really fundamental.
Health insurance. Yeah, the core fight, according to these sources, is tied directly to extending those Enhanced Affordable Care Act premium subsidies.
The ACA subsidies, and those are set to run out at the end of 2025.
Precisely, end of 2025. And that date is looming large for millions of people.
It sounds like a potential financial clip. I mean, the scale. What happens if Congress doesn't act?
Well, the numbers are pretty stark. About 22 million of the 24 million folks enrolled in ACA plans get these enhanced credits. Without them, premiums are projected to jump by an average of 114% in 2026.
Wow, 114%. That's hard to even process.
It really is. So let's make it tangible. The sources give an example. Take an average 60-year-old couple, maybe earning around $85,000 a year. Their annual premiums could go up by over $22,600. $22,000. That just changes everything, doesn't it? It makes healthcare potentially unaffordable overnight.
And it's not just individuals feeling this, right? Small businesses are right in the thick of it, too.
Absolutely. Healthcare is consistently the #2 expense for small businesses, right after payroll. And get this, half of all the people enrolled in the ACA marketplace are small business owners, self-employed folks, or their employees.
Half. That's huge.
It is. And the pressure's already intense. Average family premiums for small firms hit $26,054 this year. That's up from about $17,000 just 5 years ago.
So this political fight is just layering more anxiety onto an already stressed system.
Exactly. So the guidance right now seems to be, hope for the best, but plan for the worst.
Right.
Assume those subsidies expire when you're planning for 2026.
But keep an eye on the news.
Definitely. Because there's still time before the December 15th deadline to change plans if somehow a deal gets done.
Okay. So while Congress is deadlocked, the Federal Reserve actually made a move.
Yeah, they did. A widely anticipated one. They cut the short-term federal funds rate by 25 basis points.
So bringing the upper rate down to 4.0%. And just a reminder, a basis point is 1/100%. Sounds tiny.
It does. But these small moves have ripple effects. We're already seeing it in the mortgage market, for instance.
Rates are coming down.
Trending down, yeah. Lowest in over a year. The 30-year fixed averaged about 6.25% in October. But maybe the more strategic impact, thinking longer term, is on construction.
You mean for builders, the financing costs.
Exactly. Those acquisition, development, and construction loans, AD&C loans.
Yeah.
This rate cut makes borrowing cheaper for builders.
Which, in theory, helps them build more houses, potentially more affordable ones.
That's the idea. Reducing those financing costs can help chip away at the overall development cost, maybe enabling more attainable housing supply. It's a move aimed at the supply side, which is crucial.
Interesting connection there. Okay, related finance note while we're here. The Treasury announced the new I-bond, right?
Right. The Series I-bond rate for the next 6 months, November through April, it's 4.03%, a little tick up from the previous 3.98%.
Okay, good to know. So we've got policy gridlock, Fed action. Let's pivot to something more tangible for consumers day to day, like the cost of goods.
And specifically something very seasonal, Halloween candy.
The price of chocolate, specifically. It's become, as one source put it, the scariest part of Halloween this year.
Yeah, the numbers are pretty dramatic. Chocolate prices are up nearly 30% just since last Halloween.
30% in 1 year.
And 78% over the last 5 years. It's a huge surge.
What's driving that? Is it just general inflation?
Well, that's part of it, but there's more going on. We're talking tariffs, yes, but also a major global cocoa shortage. Apparently the largest deficit in something like 60 years.
60 years. Wow. What caused that?
Primarily climate issues, bad weather, disease, hitting the big cocoa-producing regions in West Africa really hard.
And you can see the impact directly on the shelves, can't you?
Oh yeah. Chocolate share of Halloween candy sales actually dropped. It was 52% last year, now it's down to 44%.
So people are switching.
It looks like it. Shoppers, especially Gen Z, according to these sources, are shifting to cheaper stuff.
Yeah.
Gummies, sour candies, things like that. They're more price sensitive and maybe following trends too.
It's a perfect little example of how a global supply chain issue, like a cocoa deficit, directly changes what ends up in your kid's trick-or-treat bag.
Totally. And the big candy companies, your Hershey's, your Mondelez's, they're scrambling. They're pushing their gummy lines harder, experimenting with smaller bars, even looking at cocoa-free options to manage costs.
Fascinating adaptation. Okay, let's shift from consumer costs to how businesses are trying to safeguard themselves in this environment. Background checks seem increasingly important.
They really are. And the trend isn't just that businesses use them. That's standard practice for verifying credentials, checking criminal history, protecting the company.
Right.
The trend is specialization. The services are becoming really targeted.
Ah, so not just a one-size-fits-all check anymore.
Exactly. Like you've got Good Hire, which focuses on speed. They claim 90% of their criminal checks come back in under a minute. They even let candidates run checks on themselves first.
Interesting. What about other niches?
Well, for property owners, landlords, there's TransUnion SmartMove. They have this proprietary thing called a residence score. They claim it predicts eviction risk 15% better than just a regular credit score.
So much more specific risk assessment.
Precisely.
Yeah.
Then you have platforms like HireRight, focus heavily on integrating with existing HR software applicant tracking systems. They connect with over 70 of them.
Making it seamless for hiring managers.
Right. And First Advantage is geared towards specific industries with unique needs, like healthcare or transportation, or even the gig economy. Plus, they have global reach, covering over 200 countries.
So the takeaway is that background checks are moving from a basic check-the-box exercise to a really sophisticated, tailored risk management tool.
That's a good way to put it. High-tech necessity now.
Okay, let's switch gears again, pretty dramatically. Let's talk about the sheer amount of money pouring into artificial intelligence right now.
Yeah, the capital expenditure, the CapEx, it's mind-boggling.
The numbers are huge. Amazon, Microsoft, Alphabet, that's Google, and Meta. Collectively, they've upped their CapEx forecasts to hit over $380 billion this year, mostly for AI infrastructure.
$380 billion. It's hard to wrap your head around that amount of spending. It really signals an infrastructure arms race.
But the market isn't reacting uniformly to this spending, is it?
No, not at all. That's a key point in the sources. Investors seem pretty happy with Google and Amazon's plans. Why? Because that spending directly feeds their massive, profitable cloud businesses. They can monetize that AI infrastructure almost immediately.
But Meta, different story.
Right. Meta's stock actually took a hit, even though their overall results were okay. Their CapEx forecast is enormous, $70 to $72 billion, but they don't have that same clear, direct path to AI revenue like the cloud giants do.
So investors are getting nervous about when they'll see a return on that massive investment.
Exactly. They're building for a future payoff, but the timeline is less certain, and that makes markets jittery.
NVIDIA's CEO, Jensen Huang, has a term for this whole dynamic. He calls it a virtuous cycle.
Yeah, the idea is that AI improves, so more people use it, which generates profits. Those profits get reinvested into making the AI even better, which leads to more use, and so on.
A self-reinforcing loop.
Right. And he sees this as just the beginning. A 10-year build-out where literally every layer of computing is being fundamentally changed by AI.
And all this digital infrastructure needs a massive amount of power, right? There's an energy connection here, too.
Oh, definitely. It's fascinating. Exxon Mobil is apparently in advanced talks to power some of these new AI data centers.
Exxon? Using what?
Natural gas plants. But here's the twist. Paired with carbon capture technology. The goal is supposedly to capture 90% of the CO2 emissions.
Wow. That's a really interesting, maybe unexpected partnership between big oil and big tech. High stakes indeed.
Yeah. Now, staying in the digital world, but focusing on content? The AI boom is forcing changes there, too. Look at Getty Images.
Their stock jumped.
Big time. Up 19% after they announced a multi-year deal with Perplexity AI.
So Perplexity gets to use Getty's images in its AI.
Yes, but crucially, the deal includes provisions for Perplexity to improve how it displays images, adding source credits, adding links back to Getty.
Ah, so it's a way for content creators like Getty to actually get credited and maybe benefit from AI using their work rather than just having it scraped.
Exactly. It could be a model, perhaps. We also saw Reddit doing well.
They beat estimates.
Yeah, strong advertising and user growth, daily active users up 19% to 116 million. But what's really interesting is their other revenues category.
What's in there?
Data licensing deals with Google OpenAI, licensing Reddit's content for training AI models. That category grew 7% to $36 million. It's becoming a real business line for them.
So content licensing for AI is definitely a growing revenue stream.
Seems like it. But content negotiations aren't always smooth sailing, are they? Look at the Disney versus YouTube TV fight.
Oh, right, the carriage dispute. Their deal expired.
Yep, and boom, over 20 Disney channels just disappeared from YouTube TV. We're talking ABC, ESPN, FX, National Geographic.
You
East End.
major blackout. What's the sticking point? Money, presumably.
Always, right? YouTube TV accuses Disney of demanding unfair rate hikes and using the blackout as a weapon. Disney fires back, saying YouTube TV refuses to pay fair market value for their content.
And customers are caught in the middle.
As usual, YouTube TV is offering a $20 credit if the blackout continues, basically paying people back for the channels they're missing. Classic hardball negotiation.
Okay, one more digital point. Fintech and lending. Affirm made a big deal.
Yeah, they secured a $750 million funding deal. It's described as an off-balance sheet loan deal with New York Life Insurance.
Okay, off balance sheet. What does that mean in plain English?
It basically means the debt Affirm is taking on to fund its buying. Now, Pay Later Loans doesn't show up directly on its main financial statements, its balance sheet. It can make the company look less leveraged, potentially lowering its borrowing costs elsewhere.
And New York Life is providing the money. They've done this before with Affirm.
Oh, yeah. This deal extends a partnership. New York Life has already put nearly $2 billion into what are called Affirm's collateral pools since 2023.
And those pools are just bundles of the consumer loans Affirm makes.
Essentially, yes. And this isn't just Affirm and New York Life. It reflects a bigger trend. You're seeing large, traditional insurance companies like Liberty Mutual, PGM2, stepping in to finance these fintech lenders.
Why are the insurers so interested?
Because interest rates are higher now. That makes consumer finance assets, the debt from BNPL, credit cards, etc., look really attractive. They offer higher returns than safer things like government bonds. So insurers are chasing yield.
Interesting. So insurance giants are essentially funding buy now, pay later.
In many cases, yes, directly or indirectly.
All right, let's shift to some maybe less visible but still impactful legal and economic things happening behind the scenes. Student loans are back in the news.
Yeah, the restart of payments continues to cause problems. There's a proposed class action lawsuit getting attention, partly because it's being financially backed by a former Trump administration official, Wayne Johnson, who used to be COO at Federal Student Aid.
Okay, and what's the lawsuit alleging?
It's targeting the education secretary and the three big credit bureaus, Equifax, Experian, TransUnion. It claims they violated the Fair Credit Reporting Act.
How so?
The argument is that they reported millions of borrowers as being late on their payments, even when the Department of Education allegedly didn't have the systems ready to properly manage all those accounts coming back online.
Yeah.
Basically, blaming borrowers for systemic failures.
And the impact on people's credit.
It's brutal. Sources confirm that for borrowers whose defaulted loans went back into collection, their credit scores dropped by an average of 63 points.
63 points. That's a huge hit. It affects everything: getting an apartment, a car loan, insurance rates.
Absolutely devastating for their financial health. It's a messy situation with big consequences.
Okay, let's end on something completely different. A unique intersection of real estate, investment, and pop culture.
Ah, yes. The Poltergeist house.
The actual house from the 1982 movie in Simi Valley, California. Someone bought it.
Yes, a woman named Rachel Powers bought it in October 2024 for $1.28 million. But she didn't just buy it. She's apparently spent nearly $200,000 restoring parts of it, the kitchen, the living room, one of the bedrooms, to look exactly like they did in the movie.
Wow. That's dedication. Is it just a passion project or?
It's also a business. She's renting it out for short-term stays. Fans can pay somewhere between $600 and $1,200 a night to sleep in the Poltergeist house.
No way. So people can actually stay there.
Apparently so. It's this incredibly niche form of experiential real estate investment, catering purely to movie nostalgia, a real contrast to the big housing supply issues we talked about earlier.
Definitely a contrast. Okay, so let's try to wrap this all up. We've covered a lot of ground.
We really have. From that potential 114% jump in health premiums to the $380 billion AI spending spree, right down to chocolate prices surging 30%.
When you pull back and look at all these pieces, what's the big picture that emerges?
I think it's this idea of a bifurcated reality, maybe. You have these huge, almost extreme actions happening. Massive tech spending fueled by market optimism or necessity, intense political fights with the real financial consequences.
All at the same time.
You have significant anxiety and cost pressure hitting average consumers and small businesses. Healthcare costs, inflation in the grocery aisle. That connection you mentioned earlier between a global cocoa shortage in West Africa and the candy choices on Main Street, USA, that kind of sums it up.
Yeah.
It's a hyper-connected, high-cost, and frankly, pretty volatile world right now.
That synthesis really captures it. Extreme spending in some areas, extreme pressure in others.
And maybe a final thought connecting back to that Affirm in New York Life deal. We're seeing these huge traditional financial institutions, insurers, with massive balance sheets getting directly involved in funding consumer debt through platforms like buy now, pay later, often using these complex off-balance sheet structures. So the provocative question to leave you, the listener, with is this. Is traditional financial risk just being repackaged and successfully shifted into these private markets? And if that's happening, what does it really mean for the stability of the whole system, especially when the broader economic signals are still so mixed and uncertain, and higher rates are making that consumer debt so profitable for investors?
A lot to think about there.
Yeah.
Is risk just being hidden or truly redistributed? Okay, we'll leave you with that question for now. Thanks for diving in with us.